Okay, hello everybody. So now I am going to be covering how to do the discounted cash flow for your company. So my example is going to be on Delta Airlines. One thing that I forgot to show in the last video that if you're having trouble with is how to find your company's 10K. So if we go over here, let me go back a little bit. If you just look up your company, so Delta Investor Relations, since I'm doing Delta, they'll have a tab that kind of shows for all the investors, any future outlook, plans, corporate profile. But what you're looking for here is financials and then SEC filings, and this is where you're going to be able to find their 10Ks and other forms that your company files for the SEC. So that's just where you can grab those to grab the data. But now I'm going to go back to the DCF model. So first you're going to lay out a table that looks like this. And over the course of this video, I'll kind of explain what all of this means and how all of this will come into effect. But we can see at first, this is our assumptions table, which we'll use out. 25% is our assumed statutory tax rate for this competition. 2.1% is our assumed perpetual growth rate that we'll be using. The current price is just the current share price. Keep this stagnant throughout your whole analysis. So this is the share price from April 3rd, and that's what I'll be using for my whole entire DCF. Shares outstanding, I'm doing mine in millions, so this means 653.13 million shares outstanding. Total debt, which we calculated earlier, we can just grab it from over here. I'm using the total debt formula in this competition, and then cash, you can just run over to your balance sheet, use the most recent year, and that'll be our cash and cash equivalents right there is what we'll have for cash. Over here, I grabbed the revenue figures from 2020 and the net working capital figure from 2020. You can grab this off of the 10K, and you'll see how this is going to come into effect a little bit later. So first, you can see there's one blank on our assumptions. This is going to be our enterprise value to EBITDA multiple that we use for one way to find terminal value. In order to find this, we can take those 5 comps we used earlier, which would be the same 5 I used for my weighted average cost of capital back here. And in order to use this, we're going to want to just look up their EV to EBITDA multiple on Yahoo Finance or whichever source you would like to use. And then we're going to find the median. Make sure you're not doing average, do median. It's kind of help normalize out if there's any outliers like this 4.88 to make them not skew your multiple as much. So I can grab the median of those, and then boom, 8.34 is the EV to EBITDA multiple we will be using. And so now what we're going to want to do is grab historical data and start filling out the 5 years of historicals for our discounted cash flow. So for revenue, we'll just do an equals, and we can go over to the income statement. And total operating revenue, we can just grab that for 2021, and then we can just drag this over, and that'll fill out all 5 years. For EBIT, for simplicity in the valuation, we're going to exclude non-operating income as we're trying to value, delta based upon the revenue generating business, not necessarily any one-time sales or anything that's not recurring. So for our EBIT figure right here, we can just go to the income statement and use operating income. We'll just do that and then drag that across. Our tax rate, you can see I already have this filled in. You can find this on the 10K. If you just go to the 10K for 2025, I'll actually pull one up as an example. So this is the 10K for Delta for 2025. In here I can go to Control F, effective tax. You can just look that up and it'll show our effective tax rate was 19% and 26% for 2025 and 2024 respectively. That's what you're going to use right here as one part of the formula for unlevered free cash flow is going to be EBIT times 1 minus effective tax rate. So we can just do that right here. So if we do equals, and then we do our EBIT times 1 minus tax rate. Boom. That is going to be this is actually our NOPAT. Let me change that right here, which is just after taxes. So we'll do NOPAT. Depreciation and amortization. This is going to be easy to find. What we're going to do here is we can just grab the equal sign. We can run over to cash flow statement. Over here, we're going to see depreciation and amortization. We can grab that and just drag that over. Perfect. Let me just double check. 24. Okay. And then so next for capital expenditures, this is basically just going to be PP&E. And where we can find this is if I go to the cash flow statement, I can see cash flows for investing activities. And in Delta's case, they have a flight equipment and then ground property and equipment. This is going to be my CapEx expense for Delta. So I'm going to do an equal sign. I'm going to go over to the cash flow statement, flight and property equipment. Actually, to make this simpler, I don't want negative values on this, so I'm going to do equals absolute value, which is just going to do the absolute value. It'll take out the negative. Cash flow statement, flight equipment plus ground and equipment. And we'll do a parentheses at the end. And that'll be our CapEx. And now for net working capital. Now, in this competition, a way we'll use to calculate net working capital, the way I'm going to use here is just current assets minus cash minus short-term investments minus current liabilities minus debt. So let's go ahead and grab that calculation right here. So if I go to net working capital and equals and start it out with a parentheses. So let's go find current assets cash so we can go to our balance sheet. Total current assets, we're then going to subtract our cash. We're then going to subtract short-term investments, put a parentheses there, and then we're going to do a subtraction, another parentheses, and we're going to do current liabilities. And then we're going to subtract from that. We're going to subtract everything we use for debt. So that'll be current maturities of debt and finance leases. We'll also subtract out current maturities of operating leases. And then we'll also subtract out this fuel card short-term debt obligation in Delta's case. And then boom, that'll be our net working capital. We'll go ahead and drag this over. And that'll be our net working capital. It's negative in this case. This basically just means that Delta has a lot more current liabilities than they do current assets. So now we're going to do our changes in net working capital. This is the part that's actually going to come into account for our unlevered free cash flow calculation. This is just going to be current net working capital minus previous net working capital. That's why we grab the 2020 figure right here. You can grab that, drag that over, and then boom. So now we can walk down to unlevered free cash flow. So in this case, we can do an equal sign. We'll do our NOPAT, which is just the operating income after taxes. We are then going to add depreciation and amortization. We'll subtract CapEx, and then we're going to subtract changes in net working capital. And that'll be our unlevered free cash flow for 2021. And then drag this formula over, and now we have our unlevered free cash flow for these 5 years respectively. So this is the historical data. So what we're going to go into next is how to calculate and how to grab the next 5 years of free cash flows and do a projection, which we're then going to use to discount those back and get the present value to try and get the enterprise value of the company. Okay, so now I'm going to dive into projections for the next 5 years to get our unlevered free cash flows. And I do want to note that for this example, I'm going to keep this extremely simple, just using compound annual growth rate, which you'll see. But I would recommend doing a lot of research with your team on the projections. This is one of the parts that I would dive the most heavily into. And maybe try and imitate a cycle in your next 5 years would be a good way to kind of do a healthy projection. But for this example, I'm just going to be keeping it very simple and kind of just running through how to actually fill out a discounted cash flow. So this one may not be the most accurate example, but it's kind of just more of a conceptual how-to. So for this, I'm going to go ahead and run through compound annual growth rate. For this example, I'm only going to be doing 2022 to 2025, and that is for the reason that in 2021 we had a COVID drop. You could do different weightings and everything, which I would maybe recommend looking into whenever you do this DCF yourself. Just in this example, I just want to get this video out, so I'm just going to be doing a simple example just to show you how. So for this, I'm just going to grab my ending value. This is the compound annual growth rate formula minus our beginning value. Then going to put that at the exponent of 1 divided by the amount of years. 1, 2, 3, 4. We have 4 years. Then I'm going to subtract that by 1. And that is incorrect for some reason. Divided by 4. I know I made a quick typo. It is not minus, it's divided right here. Apologies for that. There we go. There's our compound annual growth rate. And I am just going to copy this among these for simplicity. You could do like a decay model. That's just up for your team to decide how you want to do these projections. So then basically all I'm going to do is I'm just going to do the previous year's revenue, and then I am going to multiply that by 1 plus our growth rate. That is going to be a simple revenue projection. Remember, just do research with your team on maybe how to do this a little bit more accurately. Actually, I do think these projections are going to be a little high. So just for a little bit more accuracy, I'll just try and incorporate a little bit of a decay structure in this. But yeah, do a lot of research on the projections, but for this example, I'm just kind of showing how to fill it out. So just so that rate decays a little bit. For EBIT, so now I'm going to find our EBIT margin on these past 5 years. So for that, it's just going to be, well, I'm going to keep it straightforward, but I'll do this anyway. EBIT divided by, boom. That is going to be our EBIT margin. It's going to be our percentage. Put that at 2 decimal points. So this is just basically the margin of EBIT to revenue growth. Since I only used 4 years of historicals for here just to normalize out COVID, to keep it simple, I'm just going to do the same here. I'm just going to grab the average of this equals average EBIT margin, and then I'm just going to keep this stagnant in this example. Let me revert that. And then what I'm going to do, I'm just going to put this as our projected revenue times my EBIT margin, 4-year average. And then boom, that is a simple way to grab an EBIT projection for the next years. For statutory tax rate, so we're just going to use the 25% tax rate assumption in this section. So I'm just going to go ahead and grab that. I'm going to put 25%, and I'm just going to copy this over. That is going to be an easy way for that. Our NOPAT, this is just going to be our EBIT after tax. So we're just going to do EBIT times 1 minus our tax rate. That is going to be our NOPAT projection. Depreciation and amortization. For my simple projection here, I'm basically going to find depreciation and amortization as a percentage of revenue, and then find the 4-year average, and then use that here. I would not say this is the most accurate way to do it, but this is just how I'm going to do it for this video for simplicity. But like again, just do research with your team to kind of figure this out. So I'm just going to make a short little table right here. I'll just grab 2022. I'm just using 4 years to normalize out COVID, but I would recommend your team maybe look into a way to incorporate that financial to have more accuracy. So I'm just going to grab this. I'll do our depreciation and amortization divided by our revenue for that year. I'm going to put all this as a percentage. This one too. And I'm going to put this at 2 decimals. Boom. And I'm going to equals average for your average of that. So this is basically just me finding that the average on the last 4 years, that depreciation is around 4% of revenue. So then I'll just do equals, and we'll do this, times just the percentage times the revenue. That's my projected, our basic projected depreciation expense. So we'll go ahead and run that out there. CapEx, I'm just going to do the same thing for simplicity. So I'm going to make another little table here. I'll go ahead and label this D and A. And do this one CapEx. And then what we'll do here, same. And yeah, I'm not incorporating any decay structure or anything complicated here, but I would recommend your team. I know I sound like a broken record right now. Apologies, but I would recommend, trying to make this as in-depth as possible for um, your projections, just for the sake of having a quick video. I'm kind of trying to keep it or keep it short and sweet. So yeah, that'll be our CapEx projection. Net working capital. So for this, how I'm going to do this, I'm actually just going to project out net working capital as a percentage of revenue. And then I'm going to do the changes in net working capital calculation instead of calculating changes in net working capital as a percentage of revenue. Equals net working capital, wrong year. Equals average. Not that times. There we go. Apologies for the mistake. Put this down here. Boom. And then same formula for changes in net working capital. We're just going to do new minus old. Boom. Carry that out all the way. Perfect. So now we can run down to unlevered free cash flow. So what we'll do here, we're going to do an equal sign. We're going to start at our notepad, just EBIT after taxes. We're then going to add depreciation and amortization. Same formula. We're going to subtract out CapEx. We are going to then subtract again changes in net working capital. Boom, there's our unlevered free cash flow. Next 5 years, that is our projections right there. Now we're going to want to run and find a terminal value. And so what we're going to do is we're going to use two different ways to find terminal value. And then we are going to find the average between those just to kind of get a mix in valuations. You could weight this, like you could have 60% weight to the perpetual growth method and 40% to the EV to EBITDA. This is just going to kind of be up upon your team to decide how y'all want to weight that. But for perpetual growth, how we're going to do this is we're just going to do the ending year free cash flow projection. And these free cash flow projections are not the most accurate. So I would not consider this example I'm doing the most accurate DCF just because my projections are extremely simple. But yeah, just running how to do it. So ending year free cash flow projection, we'll then do 1 plus our perpetual growth rate that we put in our assumptions up here. And this is the assumption for the whole computation. So for everybody watching this, your perpetual growth rate can be 2.1%, tax rate be 25%. That's just the structure of the case. We're then just going to divide that. So we basically have our final year free cash flow projection plus 1 times our perpetual growth, or times 1 plus the perpetual growth rate, and we're going to divide this by our discount rate, which is our weighted average cost of capital. minus the growth rate. Boom. There is our perpetual growth terminal value. So then I'll just put the decimals down right here. Now for EV to EBITDA, this is where our EV to EBITDA multiple we came in earlier. Basically what we're going to do is we're just going to do EV to EBITDA multiple times our EBITDA. So for EBITDA, we have our EBIT plus depreciation amortization of our final year. So we have our EBIT projection plus depreciation amortization right there. And then that'll be our final year's EBITDA. And there is our other way. In this example, there is a huge discrepancy between these two. This would probably have to be explained in the DCF. I imagine it's just due to my basic projections with the unlevered free cash flow being low. This is what I would consider this to be a low unlevered free cash flow for what this year would be, because let's say we compare earlier, we can see that EBIT, so like for example the EV to EBITDA, we're basing it off of EBITDA, where perpetual growth is based off of the last year's free cash flow projection. So we can see that in 2025 our EBIT was 5822, and our unlevered free cash flow is only about 1,500 less than that, whereas this we have a 5,000 gap. So this is for sure not the most accurate. So just remember, take these projections that I did with a grain of salt. They are very simple, not the most accurate way, but I hope that this still kind of shows you how to fill out the discounted cash flow. So this will not be the most accurate, and there's a huge discrepancy between these two numbers. If you need help with more accurate projections, just reach out to me or your student mentors that'll be assigned soon, and we'll be able to help you out. But yeah, so we took the average of these, and then now we are able to find our enterprise value. Okay, so now I'm going to run down and we're going to grab an enterprise value for Delta, which is eventually going to bring us to the company's equity value. So we can finally get our intrinsic value of the company and get that implied share price. So this one's going to be a long formula because we're basically going to be discounting all of these future free cash flows to present value. Now, one thing I would like to note is that in this example, we have something called time periods. This is basically just how much we're going to discount, how many years we're going to discount this cash flow to get the present value. Now we are in April of 2026, so technically it is not one full year of discounting for a projection of 2026. What I'd maybe recommend looking into for all of your teams is the Q1 2026 data for your company. As of the time that I'm filming this video, the Q1 data for 2026 is not out for Delta, but what you could do is you could add basically another column here saying Q1 2026, and then you could add in those financials there, and then you would continue it on with the rest of 2026 being just a 0.75 time period, then 1.75, then 2.75, then 3.75, etc. So if you want a more up-to-date analysis, I would consider including that Q1 data, as it may already be out for your company if not releasing very soon. For example, Delta's is stated to release on April 8th. So for enterprise value, let me fill this out right here. So we're just going to do equals. I'm going to put a parentheses right here. First year of future projected free cash flows. We're then going to divide that by parentheses 1. I'm actually going to do 2 parentheses here just to make sure. We're just going to do 1 plus the weighted average cost of capital, which is going to be our discount rate right here. And then we're going to put that to the exponent of how many years we're discounting. This, in this scenario, is 2026, which would just be 1 year to discount it. Boom. So that'll be our discount right there. Next, we're just going to basically do this for every year on repeat. So then I'm just going to do a plus sign. Same thing. Take that. Then we're going to divide that by 1 plus discount rate. But then, since this is 2027, 1 more year out, we are going to put it to the exponent of 2 years because it is 2 years out. And then boom, that's our formula for that section. And then here, my parentheses are slightly off right here. So let me fix that real fast. There we go. And then we'll just continue this along. 3rd year's free cash flow divided by 1 plus the discount rate to the exponent of 3 years. Fourth year free cash flow. Our discount rate. And that is going to be to the exponent of 4 years. And then for our final year, we're actually going to grab our final year's unlevered free cash flow, and then we're also going to add our average terminal value that we found over here. And that's going to be our numerator. And then I'm going to put an extra parentheses here. Divide that by 1 plus our weighted average cost of capital. And I'll post a in the description kind of what this formula looks like, just for simplicity. And then we are going to discount this by 5 time periods, since we are 5 years out. Boom. And there is our enterprise value that we calculated for delta. So now we are going to do the adjustments to then get the equity value. Okay, so now for calculating our equity value, we need to grab our cash figure, which will just go to the balance sheet. We'll go to cash and cash equivalents for most recent year. Our debt figure, which would be our total debt, which will just be, actually we grabbed it right here. And then you're going to see minority interest and preferred stock. These are things that we're going to subtract from our enterprise value to our equity value. Funnily enough, in this case, Delta does not actually carry or doesn't have any outstanding minority interest or preferred stock at this time, but you will find these figures in the balance sheet under stockholders' equity. I just went and double checked; they do not have any, which is kind of funny in this scenario. So for both these, Delta would be a 0, but check on this for your company. You may see it under stockholders' equity, and that'll be something you'll have to subtract out. So then in this scenario, we're just going to do equals enterprise value plus cash minus debt. And that is going to be our equity value of the company. We are then going to divide the equity value by shares. So we're just going to do equals our equity value divided by how many shares. So remember, both of these figures are in millions, so this works out. This means we have an equity value of 36.9 billion, and there are 653 million shares outstanding. So just make sure you have that one thing common across all of this. All of these figures are pictured in millions. And then boom, that's going to give us 56. So what does this mean? This means that in my discounted cash flow I calculated, so I'll put this as intrinsic value right here. And remember, our market value is the current share price. In our discounted cash flow, our intrinsic value, which, let me go back a little bit right here. I'll do equals intrinsic value minus market value. So yeah, showing that our intrinsic value is showing a share price of $10.26 less than the market value, which means our upside is negative $10.26. This is where you can base your target price off of and your stock pitch. Now, always there's going to be more factors than just the discounted cash flow intrinsic value for basing your share price, but it's kind of a good starting point to base what your target price may be for your company. Take this figure with a grain of salt. I think this is a little bit bearish. than what a normal discounted cash flow would be for Delta, just because of my simple projections in this scenario. But let's just say that, the discounted cash flow grabbed this intrinsic value of $56.50 per share. That is less than the current market value of Delta, meaning that my discounted cash flow model is um, valuing the actual, equity value of Delta at lower than what the market is valuing Delta at, which could be a bearish signal in this scenario. So that's just kind of a way to interpret your DCF. I hope that this video was kind of a good way to run through the discounted cash flow. The main note that I would give to everybody watching is that with your team, one of the ways you're going to have the most accurate DCF is how good and in-depth your projections are for all these figures we pictured in the next 5 years. The ones that I use were extremely simple, able to be done in a couple of minutes, but I would really recommend doing some DCF research, doing some company research on maybe the best ways to project out all of these figures for your unlevered free cash flow calculations. And what I would recommend is almost try and capture a cycle, all the way from a low point to a peak in your next 5 years of projections. That's kind of going to give you some accuracy in your discounted cash flow. Um, but I hope this video is helpful with like actually filling out a discounted cash flow, all of the components that are needed to run one. And yes, again, if you have any questions, please reach out to me. I can help you out with maybe finding some figures in the 10K that are tricky to find, or if you maybe, you know, completed a discounted cash flow and you want me to come look over it or check on a projection that you'll have, I am happy to look over that. So, back again, just going from square one, the first thing I would do is grab the three financial statements, put these in Excel. It's going to make your calculations a lot easier. I would then watch the first video I made to calculate a weighted average cost of capital, and then you can come and do the discounted cash flow. In my next video, which I will be releasing soon, I'll be showing how to do a sensitivity analysis and kind of more on how to value the discounted cash flow and actually interpret this intrinsic value figure that this model got us. But yeah, I appreciate all of you for listening, and good luck with filling out your discounted cash flow.